Friends, thank you for being here today. We live in an era where numbers have lost their meaning. We hear about millions, then billions, and now trillions, until our eyes glaze over. We look at the debt clock ticking away in New York City, spinning so fast it's a blur, and we feel a sense of unease. We know something is wrong. We know that in our own lives, if we spent more than we earned year after year, eventually the bank would come for the house. Eventually the credit cards would stop working. But for the government, for the world economy, the party seems to go on forever. What if I told you that the crushing national debt we hear about every day is on a mistake, an accident of bad policy, or the result of politicians who simply can't do math, but is instead a carefully designed product working exactly as its architects intended? And surely you must wonder, if every nation on earth owes money, Japan owes trillions, Europe owes trillions, the United States owes $38 trillion, who exactly is on the other side of that transaction? These are the questions that keep us up at night. Or perhaps they should. Because the reality we face today, a reality of $315 trillion in global debt, is not a natural disaster. It is a man-made structure. It is a cage built bar by bar over the course of 3 centuries by men who understood something that most of us do not. Debt is not just a financial obligation. It is a tool of governance, a source of infinite profit, and the ultimate mechanism of control. Today, I want to take you on a journey through time. We're going to walk through history, not the history you were taught in school with dates and battles, but the history of money, the history of the debt trap. We're going to meet 4 architects, 4 men who, across different centuries, laid the 4 cornerstones of the prison we now inhabit. By the time we are finished, you will understand why the debt can never be repaid. You will understand why your taxes go where they go, and you will understand that the system isn't broken, it is fixed. Let us begin with the first phase, the foundation and the invention of permanent debt in 1694. Our story begins not in a boardroom in New York, but in the candlelit chambers of London in the late 17th century. To understand the trap, we must first understand what life was like before it. Before 1694, debt was a very human concept. It had a beginning, a middle, and an end. If a king needed money to wage war, and kings always needed money to wage war, he would go to the merchants, the goldsmiths, or the nobles, and he would ask for a loan. He would promise to pay it back with interest by a certain date. It was a risky business. If the king won his war and looted the enemy's treasury, the lenders got paid. But if the king lost, or if he simply decided he didn't want to pay, he would default. The lenders would lose their money, they might go bankrupt, and the king would suffer the embarrassment of being cut off from future credit. But here is the key. The slate was wiped clean. The debt died. It was a temporary burden, a problem to be solved and then forgotten. That all changed with a man named William Paterson. Paterson was a Scotsman, a merchant, and a visionary schemer. In 1694, England was in a dire situation. King William III was desperate. He was locked in a brutal war with France, and the royal treasury was empty. The king had exhausted his credit. The traditional moneylenders, having been burned before, were refusing to lend him another shilling. The nation was on the brink of financial collapse and military defeat. Into this desperation stepped William Paterson with a proposal so radical, so dangerously brilliant, that it would alter the course of human civilization. Paterson approached the government with a plan to form a syndicate of wealthy merchants. They would pool their gold and lend the government a massive sum, $1.2 million. In today's terms, that purchasing power would be in the hundreds of millions. But it wasn't the size of the loan that mattered, it was the terms. Paterson proposed that the government should never repay the principal. Let that sink in for a moment. The government would take the gold, but they would have no obligation to ever give it back. Instead, Paterson proposed that the government pay interest at a rate of 8% every single year, forever. Why would any merchant agree to give away their gold with no hope of getting it back? Because Paterson had secured a guarantee that no moneylender had ever received before. The interest payments would not come from the king's sporadic looting or royal whim. They would be paid by Parliament, funded directly by taxes levied on the British public, specifically duties on ships and beer. This transformed the loan from a risky gamble into a permanent, guaranteed income stream. The merchants weren't lending money, they were buying an annuity. They were buying the right to tax the public forever. To manage this arrangement, Paterson and his associates formed a corporation, the Bank of England. The bank collected the gold from the investors, gave it to the king, and in return, the king gave the bank the charter to issue banknotes. This was the final stroke of genius. The bank could print paper receipts, banknotes backed by the government's debt. These notes circulated as money. For the first time, debt wasn't just a burden, it was the foundation of the currency itself. The more the government owed, the more money the bank could issue, and the more interest the investors collected. In 1694, the trap was set. National debt stopped being a bug and became a feature. It was no longer a hole to be filled, but a mountain to be maintained. The government got its war money, the bankers got a perpetual income stream paid by the taxpayer, and the people of England were quietly shackled to a debt that would outlive their great-grandchildren. Paterson died in 1719. Not particularly wealthy himself, a victim of his own later failed schemes. But his invention, the Bank of England and the concept of permanent national debt, survived. It became the model for every modern economy. This brings us to the second phase of the plan, the expansion and industrialization of debt in 1815. As the centuries turned, the model spread. France, the Netherlands, and the newly formed United States all began to dabble in central banking and national debt. But there was still a limitation. Debt was largely a local affair. A British merchant bought British debt. A French noble bought French debt. There was no true global system. Enter the Rothschilds. If William Paterson was the architect who poured the foundation, Nathan Rothschild was the engineer who built the steel frame that would span the globe. By the early 19th century, the Rothschild family had established a unique banking dynasty. 5 brothers, sent to 5 major European capitals, London, Paris, Frankfurt, Vienna, and Naples, created the world's first international information superhighway. They moved faster than governments. They had private couriers, carrier pigeons, and fast boats that allowed them to send news and gold across borders with unprecedented speed. And nowhere was this power more evident or more profitable than during the Napoleonic Wars. The year was 1815. Europe was holding its breath. Napoleon Bonaparte had returned from exile, and the fate of the continent hung on the coming battle at Waterloo. In London, Nathan Rothschild sat at the center of the financial world. He understood something crucial. War is not just fought with bullets, it is fought with bonds. The British government needed massive amounts of cash to fund its armies and subsidize its allies. Rothschild provided it. But he didn't just lend the money, he created a market for it. Rothschild introduced the concept of selling government bonds on a secondary market. He would buy the debt from the government in bulk and then sell pieces of it to investors, pension funds, insurance companies, wealthy aristocrats across Europe. He made British debt a tradable product, like tea or cotton. But the true mastery came in how he controlled that market. The legend goes that Nathan Rothschild received news of Wellington's victory at Waterloo a full day before the official government messengers arrived. He knew the British had won. He knew that British government bonds, called consols, would skyrocket in value once the news broke, because victory meant the government was safe and could pay its debts. So what did he do? Did he buy immediately? No. He went to the London Stock Exchange, leaned against his usual pillar, and began to sell. He sold massive amounts of British bonds. The other traders saw the great Nathan Rothschild selling and panicked. They assumed he knew something they didn't, that Napoleon had won and Britain was doomed. A fire sale began. The price of British bonds crashed to the floor. The market was in total collapse. Then, at the very bottom, when the panic was absolute, Rothschild gave a subtle signal to his agents. They stepped in and bought everything. They bought up the entire British debt for pennies on the dollar. When the official news of the victory arrived the next day, the prices soared. Rothschild had multiplied his fortune instantly, but more importantly, he had consolidated control. By the time the dust settled, the Rothschilds effectively owned the bond markets of Europe. They had industrialized sovereign debt. They created a system where debt was interconnective. A British bond might be held by a French bank, which used it as collateral to lend to an Austrian prince. This innovation locked the nations of Europe together. Default was no longer just an issue between a king and a local merchant. If a major government defaulted now, it would trigger a chain reaction that would collapse banks across the continent. Governments were no longer just borrowing money. They were weaving themselves into a web from which they could not cut themselves free without destroying the entire fabric of the global economy. Rothschild made debt global. He made it liquid. And he made it essential to the stability of the world. Now we must examine the third phase, the engine that powers the system, the creation of infinite debt in 1913. We move now across the Atlantic to the rising superpower of the 20th century, the United States. By the early 1900s, America was an industrial titan, but financially it was considered a Wild West. The U.S. had no central bank. Thousands of small banks operated independently. The money supply was tied to gold. This meant there was a hard limit on how much the government could borrow and how much banks could lend. You could only lend what you actually had. This was a problem for the bankers. It limited profit. It limited control. And periodically, panic would sweep the system, causing bank runs, where ordinary people rushed to withdraw their savings, only to find the vaults empty. The panic of 1907 was the breaking point. The stock market crashed, banks failed, and the credit system seized up. One man, J.P. Morgan, the Jupiter of Wall Street, personally intervened. He locked the leading bankers in his library on Madison Avenue and forced them to pledge their own money to keep the system afloat. It worked, but Morgan and his associates knew they couldn't do it again. Morgan was old. They needed a permanent solution. They needed a system that would guarantee their liquidity and ensure that the government could borrow without limit. They needed a central bank. But there was a catch. The American public hated central banks. They viewed them as tools of the British monarchy and the European elite. A central bank would never pass through Congress if it looked like a central bank. So they engaged in a conspiracy that sounds like fiction, but is documented historical fact. In November 1910, a private train car with the blinds drawn left Hoboken, New Jersey, in the dead of night. On board were the most powerful men in American finance: Nelson Aldrich, the Republican whip in the Senate; Frank Vanderlip, representing the Rockefellers; Henry Davison, a partner at J.P. Morgan; and Paul Warburg, a representative of the Rothschild banking dynasty in Europe. They traveled to a secluded hunting club on Jekyll Island, off the coast of Georgia. For 9 days, living in complete secrecy, using only first names to avoid detection by servants, they drafted the legislation that would become the Federal Reserve Act. Their brilliance was in the deception. They didn't call it a central bank. They called it the Federal Reserve System. They didn't make it a single institution in Washington. They split it into 12 regional branches to make it look decentralized and democratic. They claimed it would stabilize the economy and protect the common man. But the structure they designed was pure genius for the banking class. The Federal Reserve would be a private corporation owned by its member banks. It would have the power to create money out of thin air to purchase government debt. Passed just before Christmas in 1913, when many congressmen had already left for the holidays, the Federal Reserve Act changed everything. Here is the mechanism that J.P. Morgan's associates unlocked: infinite debt. Before the Fed, if the U.S. government wanted to borrow $10 million, it had to find someone with $10 million in gold or savings to lend it. But with the Fed, the government issues a bond. The Federal Reserve simply types a number into a computer, or back then wrote a ledger entry, and creates the money to buy that bond. The government gets the cash to spend. The Fed gets the bond, an asset. And the American people get the liability, the promise to pay interest on that bond forever via their taxes. This removed the brakes from the train. There was no longer a natural limit to government borrowing. As long as the Fed was willing to buy the debt, the government could borrow millions, then billions, and eventually trillions. The money supply became elastic, expanding primarily through the creation of debt. Morgan and his circle built the engine of inflation. They ensured that the government would always have a buyer for its bonds, meaning the interest payments, the wealth transfer from taxpayer to the banking sector, could grow without limit. Finally, we arrive at the fourth phase, the enforcer that ensures the trap becomes inescapable, established between 1979 and 1982. We have seen how debt was made permanent, how it was made global, and how it was made infinite, but there was one final piece of the puzzle needed to secure total control. What happens when the debtor can simply no longer pay? By the 1970s, the system was straining. The post-war economic boom was fading. Developing nations in Latin America and beyond had been encouraged to borrow heavily from Western banks to fund infrastructure and modernization. They borrowed billions of dollars. But in the late 70s, the U.S. faced a crisis of its own: stagflation. Inflation was soaring over 10%. The dollar was losing value. The chairman of the Federal Reserve at the time was a man named Paul Volcker. Volcker is often hailed as a hero who broke in the back of inflation, and he did. In 1979, he took the radical step of raising U.S. interest rates to unprecedented levels, peaking at 20%. For the average American, this meant mortgages became unaffordable and businesses struggled. But for the developing world, it was an apocalypse. Mexico, Brazil, Argentina, they had borrowed money when interest rates were low. Their loans were often adjustable rate or required rolling over. Suddenly, the interest payments on their national debts tripled or quadrupled overnight. At the same time, the global recession caused by Volcker's hike meant nobody was buying their exports. They were trapped. The interest alone was consuming their entire national budgets. In August 1982, Mexico informed the U.S. Treasury that it was out of money. It could not pay. This was the moment of truth. In a free market, if you lend money to someone who can't pay, you lose your money. The U.S. banks, Citi, Chase, Bank of America, had lent dangerously huge sums to these countries. A default by Mexico would have wiped out the capital of the biggest banks in New York. The system should have cleared. The banks should have failed. But Paul Volcker and the international financial establishment did not let the market clear. They introduced the final innovation, the bailout restructuring. Volcker, working with the International Monetary Fund, IMF, orchestrated a rescue. But it wasn't a rescue for the people of Mexico. It was a rescue for the banks of New York. The IMF lent billions to Mexico and the other struggling nations. But the money didn't go to build schools or roads. It went straight back to the New York banks to pay the interest on the old loans. It was a money laundering operation to keep the loans listed as current on the bank's books. But this new money came with strings attached. Chains, really. These were called structural adjustment programs. In exchange for the bailout, nations were forced to agree to brutal conditions. They had to cut spending on healthcare and education. They had to sell off state-owned assets, water companies, electric grids, oil fields, often to foreign corporations at fire sale prices. They had to reorient their economies to prioritize paying foreign creditors above all else. This was the Volcker legacy. He proved that when debt becomes unpayable, the system does not accept a loss. Instead, it uses the debt as a lever to strip mine the assets of the debtor. The debt is never forgiven, it is restructured. It is stretched out. The country remains a debtor forever, sending a portion of its GDP to the financial centers of the North in perpetuity. This model has been repeated in Asia in the 90s, in Greece in 2010, and continues in the global South today. Debt is the weapon that conquers nations without firing a shot. The reality: the silent confiscation of your life's work. Now, friends, before we look at the final cage, I must address the shadow that hangs over this room. I know many of you are sitting there thinking, this is terrible history, and these global games are frightening, but I have played by the rules. I have worked for 40 years. I have my savings. I own my home. I have a pension. I'm insulated from this international debt trap. I wish that were true. But the most insidious part of this system is not what it does to nations across the ocean. It is what it does to the money in your pocket right here in America. You see, when a system is built on infinite debt, there's only one way to keep it from collapsing. You must devalue the currency. If the government owes $38 trillion and they cannot pay it back with valuable dollars, they must pay it back with cheaper dollars. This is what we call inflation. But do not be fooled. Inflation is not like the weather. It doesn't just happen. Inflation is a policy. It is a slow motion default. It is the system's way of reaching into your bank account, into your 401k, into the mattress where you hid your cash, and stealing a percentage of your life's work every single year. Think about the world your parents lived in. A single income could buy a house, a car, and support a family. Today, your grandchildren need 2 incomes just to rent an apartment. Is that because they are lazy? No. It is because the money they are paid in has been hollowed out from the inside to service the debt of the state. This is the invisible tax. When the Federal Reserve prints $1 trillion to buy government bonds, they are not creating value. They are diluting the value of every dollar you already own. It is a transfer of purchasing power from the saver to the debtor. For those of you on a fixed income, this is the ultimate betrayal. You agreed to a contract. You worked when you were young so you could rest when you were old. But the system has broken that contract. They have kept interest rates artificially low for years to make it cheap for the government to borrow, which means your savings earn nothing. And then they drive prices up, meaning what little you have buys less. They are liquidating your retirement to keep their game going. I want to pause here for a moment. Does this resonate with what you are seeing at the grocery store or in your own savings account? Have you felt the pinch of this silent tax eroding your future? I would love to hear your thoughts in the comments below on how this system has impacted your personal economy. And what of the next generation? What of the legacy we leave behind? We are handing them a bill they can never pay. We are handing them a currency that is losing its function as a store of value. We are handing them a system where the only way to get ahead is not to save, but to speculate, to gamble, in the very casinos that the bankers control. This is why the debt trap is personal. It is not just about balance sheets in Washington or London. It is about the theft of your time. Every hour you work to earn a dollar that is now worth 70 cents is an hour of your life that was retroactively confiscated by the system. They have designed a world where you must run faster and faster just to stay in the same place. And as long as we accept that inflation is normal, as long as we accept that sovereign debt is a safe asset, we are voluntarily walking into the slaughterhouse. We are letting them turn our labor into their leverage. And with that sobering reality, we see that the cage is truly closed. Friends, look at where we are today. We stand beneath the shadow of a $38 trillion national debt in the United States and over $300 trillion globally. We are told this is a crisis. Politicians go on television and argue about spending cuts or tax hikes, pretending that if we just tweaked the budget, we could pay it off. But if you have listened closely to the story of Patterson, Rothschild, Morgan, and Volcker, you know the truth. The system is not designed to be paid off. If the United States paid off its debt tomorrow, if it redeemed every bond, the money supply of the world would collapse. Because in our system, money is debt. The Federal Reserve creates money by buying debt. No debt means no money. The system would seize up and die. Therefore, the debt must grow. It must grow forever. This is not a bug. It is a business model. Think about the $1 trillion the U.S. government now spends every year just on interest payments. Where does that money come from? It comes from your paycheck. It comes from the hours you work, the value you create, the taxes you pay on your income, your gas, your home, your purchases. And where does it go? It goes to the holders of the debt, It goes to the Federal Reserve, to the commercial banks, to the massive asset management firms, and to foreign central banks. It is the greatest transfer of wealth in the history of mankind. A continuous river of value flowing from the working class, the people who create things, to the financial class, the people who own the debt. They designed a system where the government borrows forever, you pay interest forever, and they profit forever. It started with a permanent loan in 1694. It became a global web in 1815. It became an infinite printing press in 1913. And it became an inescapable political shackle in 1982. If you are finding value in this history, if you think more people need to understand how this cage was built, please take a second to like this video and subscribe to the channel. It helps us get this truth out to more people who deserve to know. So, when you see that debt clock spinning, do not look at it with confusion. Look at it with understanding. That is the sound of the system working. That is the sound of the rent we pay to live in a world owned by the architects. They designed a system you can never escape from. The question now, friends, is not how do we pay it off. The question is, how long do we agree to play the game? Thank you.